Sometimes the action in a stock just seems so obvious, yet you only notice it after it happens. So on a day where we're all anticipating what the Fed will do on Wednesday, with the Dow dipping 111 points, S&P advancing 0.38%, NASDAQ gaining 1.24%, to a record high, by the way, I think it's worth reflecting on why we didn't grab hold of certain opportunities, ones that in retrospect seem so obvious, so we don't miss similar ones in the future. The first mistake we made, and I am speaking collectively, was in truly believing that the fundamentals always matter. I know from experience that this is just not always true. For example, there are these cult stocks. These are stocks where what's happening at the company and what's happening in the stock are two very different animals. But unlike meme stocks, cult stocks have such a loyal shareholder base, they can trade independently of the business for years and years. The most obvious example, Tesla. This rally since the election is one for the ages. It's a move that, in retrospect, everyone should have seen coming, right? I mean, why not? Elon Musk has been all in with the winner of the presidential election. The electric cars are doing much better than everyone else's. Full self-driving could be around the corner. But now let's look at what might have kept you out of the stock. If you go back in time to when we found out that Elon was a big-time Trump supporter, the media was filled with, "How long will that last?" chatter. The president-elect is famously mercurial, while Elon Musk is obviously brilliant but equally arbitrary and capricious. The idea that these two could bond in any way before they clash seemed inevitable. Plus, electric vehicle sales, they were sinking everywhere. We saw adoption slow for all EVs, including Tesla, in the United States. The competition in China, it became cutthroat. Musk's Tesla is a relatively high-cost producer. Numbers, the estimates, they kept going lower. Plus, there was this lawsuit about him getting his bonus where it wasn't clear that he'd stick around as CEO if he lost. Too easy to pivot to some other part of his empire. Now, of course, the reality turned out to be quite different, but it was easily missed by the numbers guys on Wall Street. First, the public is back into the stock market, bigger than ever. The public doesn't listen to Wall Street research. Many don't even know what it is. Others think it's worthless. The public knew one key thing that the analysts didn't. Musk was incredibly close to Trump, spent hundreds of millions to help them win. So as long as Trump won, Tesla was going to be a huge winner. You had to be on board. You had to believe. It was like a sports team. As it is, it turns out Tesla has more driving self-data than Google-backed competitor Waymo, data that Trump will buy into maybe and crown Tesla the full self-driving winner versus the piecemeal city by city approach of Waymo. Maybe it gives them the whole interstate highway system. I don't know. It also helped that GM dropped out of the self-driving taxi business, making Musk view more of reality. Tesla's much more than just a vehicle company. It's a tech company on wheels. Of course, Tesla's up 86% for the year, with nearly all of that coming after the election, when we realized that not only is Musk tight with President-elect Trump, he's helping reform the government to Trump's liking, doing a lot of this. Or he plans to. Once you get a CEO with that kind of political influence, it's easy for the faithful to imagine the unlimited possibilities, which means they're no longer constrained by the price-to-earnings multiple. They'll pay anything for Tesla, much higher than these prices. They're actually insensitive to price. Oh, and did I mention that brokerage firm Mizuho just upgraded the stock from hold to buy off of an improving outlook under the Trump administration a few minutes after the market closed? Next up, Netflix. What the heck were we thinking when we didn't own Netflix? Is there a week that goes by where we don't talk about a Netflix show? The big linear TV networks like to do expensive shows about fires and hospitals and police. Fire Country Hospital PD! It's been their formula since the 1970s. They just keep doing the same thing, failing each year. But Netflix, hey, they come up with things like Jake Paul versus Mike Tyson, and it did huge viewership numbers. I tried to get it. I mean, it's like, what the hell was that? It didn't work, at least when I was trying, but it didn't matter. Millions of people watched it. We're 10 days from the start of Squid Game 2. Take that, Fire Country! We watch all sorts of what the hell, Fire? We get all sorts of programming from other countries because we've been taught by Netflix to like subtitles. It's insane how good this company is. Honestly, convincing Americans to read subtitles, that may be the most important cultural event of the 21st century. And yet Wall Street doubted Netflix the whole way when it came to their new ad-supported subscription tier. They didn't get it perfect right out of the box. They told us, well, many of these who followed the company presumed it was a bust. Oh, it was hardly a bust. And it's just going to get bigger and bigger. It's easy to say, of course, that it wasn't, anyone could have had it. But those who spend their lives examining this company thought otherwise. They said, stay away. And they're the professionals. Who are we to doubt the professionals? They doubted the ad tier. Who are we to doubt them? And then there's the multiple, the darn price to earnings multiple. Netflix was always selling for 50 times earnings, which is just too high for the people who care about valuation. Those people aren't the general public. They aren't the home gamers. And the home gamers who love Netflix, they won. Cold stock that's up 89% for the year.
That was easy.
Then there's Palantir. Now, this enterprise software / defense contractor is a real company. I mean, like, totally real. It has a tremendous business model. It could change the entire Defense Department budget. But in some ways, Palantir is a renegade company playing by its own rules. Like AMC, the theater chain, the CEO actually caters not to Wall Street, but to Main Street. Individual investors. The difference is that when it comes to enterprise software, you don't use price to earnings models. You use this difficult to understand rule of 40, where you add the revenue growth rate to the EBITDA margin. If the sum is above 40, then you got a winner. Most companies that are losing money can't reach that number, but some can if they have incredible revenue growth. Palantir appeared to be losing money hand over fist, but it passed the rule of 40 test with flying colors. Since then, the growth's been accelerating rapidly. The profits are exploding. It's among the fastest growers in the entire industry. Top of the rule of 40. Plus, like Tesla, Palantir, tight with Trump. So why didn't we see it? Because the CEO was too brash and the actual business too opaque? By nature, what they do is secretive. But there are plenty of renegade traders and investors. See, they saw it. The kind who made money and got out of AMC near the high when the CEO sold. The kind who made $100 or $200 with GameStop. These people bought Palantir on CEO Alex Karp's say-so. To them, it was worth a lot more than anything else, even as it was worth nothing to Wall Street analysts who covered it. Now, Palantir's made a major breakout. It is up 340% per year. Seems obvious in retrospect, but it was anything but at the time. A stock that's been gunned by retail, that now, because it's about to have a real earnings breakout, is finally being beloved by institutions. Oh, and the individuals who still like it, they start their buying at 4 a.m. and they walk it up right into the opening. It's wondrous to all get up early and see it happen on the crawl sometime. By the way, you don't even have to worry. They do the same thing at 4 p.m. Right after the closing bell, they take it up maybe like 30 cents, 50 cents, usually about $1. Here's the bottom line. There's a lesson here, and it's a brutal one. Sometimes conventional methods of valuation are completely worthless, and you need to embrace the dynamics of cult stocks.
House of pleasure.
The trick is to recognize when we're in one of those moments. In 2025, let's do this. Let's strive to find the stocks of companies that do defy orthodoxy. Some will prove to be wrong, but if 2024 is any guide, the ones that prove to be right will more than make up for any of those losses. I'm going to start the question with Tommy in Texas. Tommy.
Yes, Jim.
Tommy.
Yes, booyah to you. My question concerns the refineries, specifically Marathon Petroleum. Where do we go from here? Buy, sell, or hold?
Right. Well, I think that our view is that President Trump